Let me welcome on to all Mr. Puneet Khurana. Puneet is currently the founder and CIO at Stoic Investment Managers.
Thank you. Actually, I was surprised when they said that there is so much interest about a topic called food by Backtests. To be very honest, can you tell me what exactly excites you about this topic? Because I'm actually thinking this is going to be like something people don't care about. Honestly.
So probably something that shows this and you don't even know.
Okay. Well, that is not it. But anyways. What do you expect? Okay, let me ask you a different question. What do you think should be covered when I talk about food by Backtests? Quick, anything?
Some data.
Some data. Okay.
Related to algo.
Okay, that is why I want this session. Anyways, what else?
Technical analysis and no meaning.
You want me to prove that? Okay.
Food by Backtests.
Okay.
Why your mind is working in a way that analysis is going wrong.
Okay. Alright. And yes.
Food by it also justifies the thought process where we want to solve it in a very easy way by just looking at the back end of the data and try to eliminate what is in it.
Okay, fair point.
Equity is not that easy.
Okay, fair point. All good. So I more or less covered all the points except for algo. Okay. And the reason, who said algo? Sorry, according to you, algo. Why I wouldn't cover that is because I want to make this session in a way that no matter what your technical background at this point in time is, there is something to take away from that. So all my examples, even though I have completely moved away from the standard working in Excel, but all my examples I'll show you with Excel only, primarily because there isn't too much examples, so don't get your high hopes. But the whole idea here is that you don't need technical skills to start thinking with. Later on you can add that. Okay, so I'll avoid as much of technical jargon as I can. In fact, I'll avoid it fully. And let's start. So, first of all, title credits, right? I've taken the topic. Everybody knows about Nassim Taleb books. I read him somewhere in 2012, 13, something like that. And this is where the idea came from. I think if I have to change this, probably I'll change food by backtest and the hidden gibberish which is not shown to you in a backtest result. Right? Because that is all there is. There's a lot of crappiness that happen. My idea would be to run you through what crappiness can go there. Okay, so this is the genesis. Now, if you are on social media, all you see is this. Fake NTM screenshots. Why don't you share your PNL? I'm not in that world, so I just see it as an outside observer and I laugh at it. But having said that, internally I also know that fake MTM screenshots, why it bothers people so much is because it has started impacting the retail audience a lot. Right? A lot of retail people fall for that and hence become the topic of discussion. But what surprised to me is that a lot of people don't talk about the much more dangerous part, which is this. The baseless backtest which you see, कि अरे हमने ये backtest किया and the CAGR was mind blowing. We beat Nifty by 10%, annually, and then we jump into that and then we see कि something is amiss, right? So, and why it has become more dangerous? Because earlier it used to impact only HNIs and larger institutions because many people backtests were not really, it was not really a domain of retail. The moment small case and other such thing happened, everybody's got to know about backtest and backtest became a selling material. Right? So everybody was subscribing. When small case started, what was there? Nothing. Backtest results. So what's the base for you to apply to something? Nothing. Backtest results. Right? So the problem was that it sounded very scientific, unfortunately. And we did a study. And this is a problem which we have. It's a problem I'm saying because no matter what we start with, we always end up doing some study. Okay, so we did the study here also. And we thought, okay, let's study backtest ka study. Okay, so all the people were giving backtest and we went to small case. At that point, the data was available and the live results were starting to come. And again, nothing against a particular company or anything like that. I'm just trying to portray that it happened. I'm not saying the intent was wrong or anything like that. It can happen with anybody. But the whole idea was that we went through live data and we went through backtest data. And we eventually contributed that if you do the overall CAGR among all the great sellers of small cases, majority of the contribution of the profit was coming from backtests. Now think about it this way. If I show you something which is 6 years, 30% CAGR, I need to screw up long enough to make that 30% fall to 20%. Simple mathematics, right? So not only I can make it 40%, it give me another more couple of years to go forward, right? So this was something which we did. I tweeted about it. It became a problem. I had a discussion with their team, etc., etc. But most of these people eventually had their live performances, and live performances were not doing at all what was there in the backtests. Okay, so there were a couple of discussions happened, and eventually in 2022 they also stopped doing this, which is a good step, right? So eventually all the CAGR, etc., should be based on live performances and not on backtest performance, right? Very simple point. Again, nothing against anybody here. One of my friends tweeted this, and I love this. Right? This is exactly how it is. Right? Strategy back results versus live trading results, and again, nothing against this person also. No offense meant, but the whole idea is that you see something else, you get something else. Okay? And the way we have always, the way I have evolved over a period of time, over the last 14, 15 years I've been working, we have evolved from a lot of narrative-driven, narrative-driven style to more evidence-driven paradigm. Okay, and there's a dramatic shift in the way we have started approaching all of the problems. So what my attempt here will be to start just one second. Okay, so what I'll start doing is I'll start giving you some idea about the evidence paradigm. Hota kya hai? Everybody comfortable in Hindi, right? Even if I say anything, anybody here is not? Okay, so I can do that, right? Okay. So when you talk about an evidence paradigm, why does evidence paradigm, how does it work, why does it work, and where does the backtest fit in, and how does the backtest can be used wrongly or rightly? That will be the attempt in this session. Fair enough? Alright. Now, the first thing is, why does narratives exist at all? What is narratives? We talk about narrative. What is it? What is a narrative?
Story.
It's a story, right? Is story a bad thing? Of course not. Is story a bad thing in investing? Yes? No? Maybe, maybe not. Depends on who you ask. Okay, but the whole problem is narratives. Why do people still, if narratives are bad, let's say they are bad. Let's go with that premise, okay? Why do they still exist? Yes, to sell, but why? Because it works, right? And why does it work? Because ultimately at the end of the day you're talking to humans, right? And without going into any of the 500 psychological biases I'm sure all of you have studied about, read about, talked about, there are primarily long things which are there, which is human mind seeks certainty, human mind seeks pattern, and if you don't have the pattern established or give some kind of a certain timeline to stories, you don't grasp what is happening. And hence, if I need to make something palatable, I need a story around something. Right? So if I want to have something palatable, of course, if I want to make marketable also, I need to build a story. That is why I'm not a good marketer. That we need to build stories, right? So we need to build stories, and that is why narratives exist. But they come with a big load of problem. Now, what is that? There's too many of them. How do you know which story is a story around a good base, or it's a story which is a shallow story, and trust me, if I can do all the solid work behind it, but if I'm not able to create a nice story of Asian Paints and HDFC, I can't even convince you of that. Okay? And no matter how bad the work I've done, if I create a good story around Asian Paints and HDFC, I'll be able to sell you that. Actually, it's an important aspect, I'm not denying that part, right? Okay, so what is evidence paradigm? What exactly we work with? The understanding is very clear. Okay? We look for, or we try to take everything and start with dissecting that particular narrative, and we say whether it stood or stands on the ground of good science. Okay, the moment I say word science, don't jump directly because that's the line people are not able to divide. The moment I say science or data, it doesn't everything means that matrix kind of algorithms running and things happening. In fact, I will cover that up. But it does involve thinking about the underlying reasons of why things exist and why they don't exist. That is the broad idea of an evidence paradigm. Okay, so the core key idea is if I say something to you, your natural stance is, where is the evidence? Or what's the evidence? That's the starting point. That's the understanding. Okay? Okay, so I probably missed putting this, but I go to the next part, which is the rebuttals. So whenever I talk about evidences and everything else, I commonly hear a few things, and I consult for and I discuss with a lot of friends in the institutional side of things. So I've come from buy side, now I'm still buy side, but not that buy side, $1 billion buy side. And the moment you come from there, you obviously discuss all these things with people who are actually managing significant amount of capital. Why do you want to do that? Is because you also want to test your own biases. What kind of evidence paradigm you're running if you can't test your own biases, right? So that is also important. But having said that, there are very common rebuttals that I hear. One is that, this is okay, but investing is an art. Investing is not science. What can I say? Right? Investing is an art. Nobody in his right mind can say that investing is science. Sure, Jim Simons might disagree, and all those people might disagree, but I'm not either of them. Take your capital, and all these quants might come and say, you don't understand anything. But I can also appreciate that there is an art part to it. But I also understand that people think art very, very differently. The second rebuttal, which I'll come to all these rebuttals later on. The second rebuttal which I hear is, then what is the value of experience? Right? So with experience comes something, and how do you differentiate between an experienced market personnel versus a non-experienced market personnel? And if experience doesn't matter, all the younger quants will be doing all the good work and the experienced people will not make money. Of course, this comes from experienced people only. I've never heard any younger guy saying, what's the matter of experience? Generally, you defend with what you have, right? So people defend with experience, people defend with. And thirdly, the rebuttal to that usually is that majority of the time I feel complexity of something is often confused as an art. Okay, so if you think deep down, you can probably convert it into more scientific way of thinking, more framework-driven way of thinking, but you don't do it because you don't need to probably. Sometimes it happens you don't need to. Right? A lot of frameworks are in your mind. You would know very experienced people, they don't really need a standard set of things, and eventually they stay in their mind. But the algorithm is running. It's just running in their minds. Okay? And that's the art part, because we don't see what's happening in the mind. But eventually, if you talk and if you discuss and if you drill down, a lot of complexity can be converted into a scientific way of thinking. That is one. Second, speculation is confused as an art. When I say speculation, I'm not talking about speculation trading activities. When you are basing a decision based on nothing but a gut feeling, not really the gut feel. Gut feel can easily be science. There is a book by Gary Klein, right, who talks about seeing what others don't and all that kind of stuff, right? So I won't use a gut in the technical sense, but there is no rational or there is nothing explainable behind something, and something you do, it works. Just because it works doesn't make it right. Okay, it has to work consistently for it to make it right. Then you can go back and ask why it is working. But just because it works one time doesn't make it right. Okay, so sometimes speculative behavior, people say, yeah, this is the art form, you can't do much. Having said that, I also realize the other thing. Okay, so I'll come to why I also agree with some of this aspect slightly later with examples. Right? So, in that sense, evidence-based paradigm is not, I don't think it is an alternate way of doing things. It's just a matter of prioritization. So all you're saying is, instead of starting with a story, start with a different aspect, which is, or let me put it this way. If I give you a thesis about, let's say, a company, okay, let's talk about a company. If I give you a thesis, my thesis will not start from, I met the promoter, I loved his vision. And these are not very unthinkable lines, right? This vision for the company is really good. Then I did some groundwork and I love the product. and then I went to Amazon, amazing reviews, and fine, all that is fine. I'm not saying any of this is wrong, but I'm just saying that is, even if that is the case, my premises or the stories will not be there. Or another thing which I heard about is the management quality is great. Why? Because he lives a frugal life. I met him, he came in kurta pajama. Some radical things helps you deciding, and all of them have value, okay, because they are your shortcuts to think what is in your mind is an evidence, right? So you see a frugal person, you by default link that, because you have other examples. Again, I'm on camera, so let's not name them. But we have the king of good times and so many people who are flashy, so you draw correlations. But not all flashy people will be chore, not all frugal people will be, and so on and so forth. Okay, I think you got the point. So, so it's a matter of, so my prioritization will shift. My first starting point is, can I validate this particular point, which is important for my thesis, with some solid information? And I'm choosing my words here, okay? Because the moment I say data, again, you will think numbers. But solid information. And solid information essentially means something which is not mixed with a viewpoint. Has to be a primary source of information. Within that, if it is in data, all the very good. Okay, now, with data comes a lot of problems, but if it can be done with data, my preference would be to go to data and see that. That also doesn't mean that if it's not in data, Einstein's statement, you know what I'm talking about? Whatever can be counted, he said something like, what can be counted, what can't be counted counts sometimes, or something like that. Okay, sorry for the statement. But it's something like that. But he said, not everything that counts can be counted. Okay, and not everything that can be counted counts. So that was the statement, right? So, and I agree with it. So why I'm doing this again and again is that I want to reinforce the point that don't think quant versus the other world. I'm not trying to take a side. Evidence paradigm is not quant-driven work. Because I'll come to more points there. So what is it about? It's a matter of prioritization. It's a matter of tested observations. So after I do a lot of these things, I have observations which are not coming from some random thought process. They have been tested. Doesn't mean that everything which is tested is gospel of truth. Okay, they are work in progress, but they are tested. Okay, and they give you a lot of good ideas. They tell you that where does your observation actually fails? When can it fail you? It helps you plan better. It helps you with your risk management. It helps you with a lot of things. Okay, so it gives you the fringe cases we need. It also gives you the base rates. How many times you can hope for it to work. Again, doesn't mean it will work, but how many times it has worked in past. If something is done, and you come up with a random thesis, and I will come to many random theses which happens, and you say, okay, this has worked 30% of the time, but you probably would not know it, because I hope everybody here will relate that a lot of times an idea in your mind takes its own form over a period of time, over the years. You keep on thinking about it, you're not done any testing, but the more you have talked with you, had that conversation with you, that idea becomes stronger and stronger and stronger in your mind. That is why I never ever try to talk to a PhD student anything other than his subject matter. Yeah, I did this mistake once. So I discussed with a PhD guy that why his thesis probably might not be a good idea to a fourth year PhD. Can you imagine what would have happened? Right, so it's that kind of a thing. So the more the idea is already ingrained in your mind, first of all, it becomes difficult to fight it. Okay, and secondly, you tend to ignore the base rates. You don't even think about base rates. And I'll come to what exactly is that. Okay, so this is it. Now, does that mean it's the golden thing we're looking for, the panacea for it? Of course not. When you work with this side of thinking, there is even worse possibility to get erroneous beliefs. Because data has a great power to fool you. Sometimes you can still take smart decisions by not doing data, because common sense thinking is there. You have been born and brought up as a human being, right? So you think in terms of stories, and you have some benchmarks to do decision making, which is a good quality decision making. Okay? But having said that, if you shift to this side of the world, there is a great chance that you will come up with huge amount of erroneous beliefs. And they happen because of these 2-3 reasons. One, it's a nature of a scientific experimentation in the first place. you have to evolve, and it takes a lot of time and effort to go through the cycle or journey. We'll see again examples. And that is a process where if you stop in the middle, you're done. And if it's more difficult, you will say, "Yeah, itna to kar liya na. Let's go with this belief system," and you will do some errors. Secondly, you can start with the wrong hypothesis altogether, or you can design your asking questions. They say asking good questions is a great skill set, right? When you work in evidence paradigm, asking good questions is the most important skill set. Designing of the hypothesis, what you want the data to tell you, is even more important than anything else which you are going to do. Okay, so poor hypothesis design gives you poor result, which leads to erroneous beliefs. Alright? So then the question is, if you have so many problems, by the way, I've written them 9 there, intellectual honesty is the only antidote. Okay? Nobody, it is so complex world that if you give the output to somebody, nobody's going to be able to tell where have you moved up. Which is why Backtests snapshot works beautifully. Right? I'll give you that 30% CAGR factor. It works beautifully because there's no way you can know what has gone into that backtest. Alright? So it works beautifully. But then why bother? That's another question which I've been asked multiple times. And if it is difficult, there's a chance of erroneous beliefs, why bother at all? Because if you do bother with it, it actually leads to knowledge. Rest everything else is not really knowledge, it's folklore, if I can use that word. Okay, but it's not really tested knowledge, knowledge which you can rely upon, and eventually, as money managers, we have a fiduciary responsibility to manage a large number of capitals. And eventually, if you do all these kind of goof-ups, you will do errors which are going to harm other people. And should I name? Okay, incremental improvement. If I've already proven something wrong, then I have to go only one step further. So I don't have to keep on coming back to something which is certainly proven wrong. And that helps you move forward with your ideas. Investing, they say, is a negative art, right? The more you have learned about what doesn't work, okay, the better you become. How do you know what doesn't work? This, okay? So that is important. And then it's a continuous improvement process. And if it is so good, why don't people do it? Why is it such a... Why do people avoid it like a plague? Well, there are two reasons here, very easy. One, there are operational difficulties to the whole thing. It's not easy. It requires a lot of data management, there are operational costs involved. Good quality data in itself in India is extremely difficult thing to do, and I'll come to all those issues. It is time consuming, okay? And the behavioral difficulties is something which I've seen if you have a great belief, right? And something says that, okay, this doesn't work. The chances are that you're going to say no to this thing and still believe what you have been believing for a long period of time. It is very difficult, and not only difficult, you need to ask a lot of questions. You can come and sit here. You guys can come and sit here. So what to do when intuition and what the data or whatever the scientific outcome is trying to tell? What do you do there? And it creates conflict. And again, as all of you must have studied, human beings love to avoid conflict, especially cognitive conflicts. Anything which leads to a cognitive conflict, the chances are that you're going to take the path of least resistance. Right? That's how the brain works, unfortunately. Okay, so there is a risk in not knowing. I'll skip this part. So how do we do things? Right? How do in our firm, how do we evolve, and how do we practice this? Okay, so this is generally a broad idea of how we think about everything we do. Okay, so there is this part which I refer to my knowledge funnel, or this is my, in Mahabharata terms, my Gyan Bhumi. Right? This is where I get all the Gyan from. And this is my Karma Bhumi, so to speak. Every Gyan I collect eventually has to go to the Karma Bhumi. What's the point of all the Gyan? Right? It's like Sheldon Cooper learning swimming by watching YouTube videos. Right? You can't, all the things you can learn, but if you don't put it to real life tests, there is no point. And then the learning happens in both the places. First, you learn conceptually, which is your Gyan Bhumi. Then you also learn with all the actions you have taken. Okay, so there are two funnels where we work with. One, this is the knowledge funnel. This is something we call, which is where we go back and dissect all the decisions we have taken, which is a part of the workflow which comes from this. And I probably hidden, or not hidden, there was no space, but I probably just wrote 3 words for the most complex of the things. Okay, so I'll come to why they are the most complex of the things. But let's focus a bit on this. So, you keep on hearing a lot of things from a lot of people, from a lot of sources. I read a lot, I talk to investors a lot. Long back I used to do a podcast to talk to investors, etc., etc. So there's just way too much information that comes your way. Okay, so just to give an example, let's say you're reading Buffett's 97 letter, and in the first line he says, we look for companies, something like that. Just read if you want to. Except for special cases, we look for companies, we believe a more appropriate measure of managerial economic performance to be return on equity capital. Okay? See the wordings there. We believe is a very important word here. We believe that this is the case. Would you agree? Perfectly. Can you even say that you don't agree? Right? There's no option. Right? So a lot of guru speak happens. We hear from, and again, I don't know the name because in Indian context there are a lot of people who come and give you a lot of ways to think about markets. Right? So something happens, something we read, something we talk to, that goes in our guru wisdom kind of a thing. People we learn from, people we read, etc. Let's say, I was reading this book called The Dual Momentum by Gary Antonacci. We also had a talk with him way back in 2014, 15, something like that. And he discussed certain ideas about how dual momentum he's been applying in the gold and equity space, and so on and so forth. Right? So you listen something. What do you do? Okay, this goes in that funnel. Then there are personal epiphanies. Right? You do all the things, you do study industry, you do all the legwork, something comes to your mind. So what are personal epiphanies? Whatever you think can make you a multi-millionaire. Right? Because every great idea that comes in your head is gold. Okay? So it goes there. And then there are folklores. A lot of things we keep on hearing about. So all of that, whatever we hear, goes in this kind of funnel. And the first thing we do is, because there is just so much of it and I am not 500 people team, okay, we have to do some kind of basic filtration. But whether it is worthy of even going to that hypothesis testing phase at all or not. Okay, and how do we do that? Some very commonsensical question we ask, which is, I can't do all these things. These are the examples of personal epiphanies and folklores. As a mutual fund sahi hai, it's a folklore. You don't know anything about it. I'm not saying it's not sahi, okay? Don't think it. But it's a, what does that even mean? Mutual fund sahi hai, right? So these kind of things, like quality stocks at any price, they'll make money only. Okay, so no matter where you buy it, and historically we have enough evidence, there is no evidence, but historically we have enough evidence. The moment somebody says that historically there is enough evidence, your brain thinks, oh, scientific, must be true. That's how it goes, unfortunately, but that's how it goes, right? So, personal epiphanies you can think about as, the other day I was trying to quantify a lot of financial shenanigans, checks we do, and we're thinking about how. So sometimes happens, just to give you a perspective on this, many times your observations are, your observations are something which gives you some kind of insight. For example, I was thinking about steel cycle we were discussing yesterday. So let's say if something comes to, okay, what if I look at the combination of the HRC spread in dollars vis-a-vis the companies which have their own I don't know, they're back in, right? So those kind of companies, and not every kind of company can have the same kind of thing. So maybe for those kind of companies, this might be a good predictor of the cyclical component of the market. Possible. Okay, where does the number come from? Something you're reading about the market. Now, the moment something like this happens, what do you do? What do you do? Generally, what would you do? The first step is somewhere you'll call somebody. That's the easiest of the things. Let me call this guy. He knows steel better than I do. Okay, let me ask him. He will also give you something which is coming from his observation only. Might be more valuable. I'm not saying it's not valuable, but it is still observation. Okay, he tells you, okay, what, $600 spread is fine. Above that, it's a good profitable zone to be in. Something like that. Right? So these kind of things which you hear about, you convert them into some kind of a thinking plane. Maybe you can combine it with valuations. Another part of the folklore is price to book, base pay, cyclicals. The easiest way to play cyclical is buy below 0.5, sell above 1 price. You heard these statements, right? I'm guessing majority of people talk about cyclicals this way. 0.5 के नीचे खरीदने का 1 के ऊपर बेचने का, right? So these are all points which come to your mind and you convert them. So similarly, financial shenanigans, a lot of things you do. So how do you check something is worthy of hypothesis or not? The first thing is you go to the source. Who is the source? Now if the source is Warren Buffett letter, of course you need to don't take it the truth, but of course you need to check the hypothesis. It warrants to look something, right? Second way to judge that is see what kind of evidence is happening given. So the first 8-10 years of my life I spent a lot of time reading a lot of books. The last 6, 7, 8 years, but last 4, 5, 6 years, I have probably shifted more toward reading academic papers of these sorts. Helps me get into more reasoning kind of things, right? So the moment you go into academic papers, you get a lot of empirical proof that why something is work. Now if somebody has already done some work, you can make that work as a base, not the output as the base. You're still testing it, but you probably see that okay, the method was okay, he's done decent work, maybe this is an idea worthy of a test. That's all you're saying. So we're just doing worthy of hypothesis part. Make sense? Okay? And of course there is always this problem, India versus global. That majority of the folklore is global folklore. Unfortunately, but that is the truth. We are only 20 years into decent size of market. Vis-a-vis 200 years of big markets, in the developed markets. Okay, so a lot of folklore is there. So we need to keep a lot of context in mind before we go something as worthy of hypothesis. Okay. Now this is where the hypothesis formulation and testing starts to happen, and this is the key layer of our work. This is where 90% of our time actually goes. Okay. Now, sorry to use this word, but it's something called first principles. Right? Why I'm sorry? Because unfortunately, in investing, the word becomes famous, and then it is used by everybody in every communication, like moat. Okay? Like circle of competence. Every annual report, everybody now talks about circle of competence. Even a cyclical commodity player comes and talks about how his company has a great moat, right? But that's the nature of the thing. Unfortunately, for the last few years, first principles have also got that status. Because everybody talks about first principles. But the key idea here is that the hypothesis testing and formulation should happen from first principles only. If you don't know the reason of why you are creating that formulation at all, when I say reason, not mathematical reason, observational, economic reason of something, you are probably approaching the whole thing wrong at the very first place, which is a lot of error I see in quantitative people doing. They start with data, they end with data. They try to get the first principle also from the data. So what has worked is also coming from the data. And I'll come to this issue again and again going forward, right? Then you have to make sure that what you're doing is robust. Okay, now, so general example I give you is, if I show you data, if I show you data saying, 20 years equity market returns has been, let's say 13%, 12%, whatever that number is. Okay, what does that tell you? Is that a good data or a bad data? You don't know. The point is that you need to, first of all, what are you trying to imply? Are you trying to imply that 12% is a long-term return? Okay, if that is what you're implying, you have to think about what is the long-term for a general person. Is it 10 years? Is it 7 years? If it is 7 years, has it worked on all the 7-year cycles? If it is 10 years, has it worked on all the 10-year cumulative cycles? Okay, so that information doesn't make sense. In fact, in one of my previous presentations, I showed some data of mutual funds from 2000 to 2010. Actually, if you break down the equity market returns, everything, the great marvel hasn't happened in the previous decade. And the next decade has been very mediocre. Okay, but we have also seen very little in terms of drawdowns in the second half. We haven't really seen a bad market since, forget COVID, because COVID was not a painful market. It was painful for a few days, right? It was not 2008 market. It was painful, but it was painful and it came fast, very soon, very fast. So every strategy worked. Okay, value worked, momentum worked, factor worked, no matter what you do, everything worked, right? So, not very strong, event to consider. But anyways, so we do keep on adding alternate variables. I'll come to this later. Okay, another thing which I want to, another thing which is very important to understand here is that it's a iterative process. You just don't do the test or you create a hypothesis and then just move to the next point. You create something, you look at the output, you see whether it makes any sense whatsoever or not. You go back, you refine things, you come back, you see the output. But again, when I say output, output should match your observations, which is the art part of things. I'll come to that. For example, if you're doing, let's say, a hypothesis formulation for quality businesses, and you see out of 20 stocks, 6 stocks are something which you'll never in your life call quality. You need to go back and check why the hell is happening. Right? Maybe there's something wrong in the way you're formulating hypothesis in the first place. Does that make sense? It's an iterative process, not a one-time process. And this is where the lot of engines we have to use. Okay, it doesn't happen. It's just not backtest. So backtest engine is a very small part somewhere in the middle. Okay, we have the TSA engine, which is the time series analysis. We have to do a lot of time series work to figure out anything good in the data. There's a correlation engine. There's a lot of visualization work to be done, etc., etc., etc. Okay, you'll see all this later on, but that's the good idea. Okay, and then there is a framework creation. Okay, what is it? We'll come back. But what is the final output? The final output is that there are certain validated, tested belief systems. Okay, these belief systems, and we constantly have to test them. Because if you have created a belief changes with market dynamics. There is no permanent belief, even though first principles are supposed to be first principles. But first of all, we are very limited in terms of data, but that's a separate problem. There are some things which change when the nature of the market or when the market becomes more sophisticated. For example, we still have great active fund managers who are beating the market. But it doesn't happen in US that the percentage will be much lower in US than the amount of people who are able to beat the market, so to speak, the broader indices. Okay, why is that? The nature of the market is like that. The market keeps on evolving. So it's a thing where if I see 25 years of data and I say active management works over passive management, it's a belief system which is fine, well tested, but it still needs constant checking to be sure that you can rely on it. So it's not a one-time thing and forget about it. Does that make sense? Alright, so after we do all this kind of stuff, eventually everything has to go into that portfolio, right? Eventually it has to flow to the final work which you do, which is manage money. If it doesn't help you there, what's the point? Okay, maybe for somebody it can become a marketing material, but eventually, what's the point? So if it doesn't go into your current movie and actually helps you better, this is a very difficult part of the person. Why? Because the strategy can work in itself as a standalone strategy. Or an idea can work as a standalone tested idea. But the moment you try to bring it into the portfolio scenario, you probably will not be able to fit it into your actions. And it happens multiple times. It can break down many things. It can break down the risk management of the portfolio. It can break down correlations of different assets which are there in the portfolio. It can break down a very simple thing. That let's say, just to give you a very simple example, let's say there are 3 strategies, and all 3 strategies are giving you, actionable points at the same time in the history. So what are you going to do for the rest of the time? I get what I'm saying. Strategy works, but they work in those phases. Let's give you a very simple example. If anybody would be doing momentum, let's say, the COVID recovery will get him in the market, right? I mean, it's very obvious. Similarly, 2011, 10 phase will get them back in the market. But so will the value also. So will the other things also in the extreme markets. Now, if every strategy works only at that point in time, you only have limited capital. And then in the strategy practice, you also see the XIR of this strategy. Great. Why is the XIR great? Because all the time it is not working, you anyways removed it out of the system. Saying we will not be in this strategy at that point in time, we'll be in this strategy at that point in time. Okay, so everything has to go back to where you are going to implement it. And this perhaps is something which can take days and days of discussion. But this is not an easy part of it. Actually, the most complex part of this whole thing is this. Then it has to go to your workflow. Okay? Why is something coming in your radar? What decision are you taking on that? Why are you taking that decision? Now, in previous class also, in previous session which I did with the CFA Society, I mentioned something that one biggest learning if you can take, if it's in the starting of your careers, the biggest help you can do yourself is start recording all your decisions. If you don't take anything from this session and just take that one thing, is that start recording why you do what you do. It probably is going to be the biggest asset you're going to create for yourself. Because if you start thinking about why and where you goof up, there is no better exercise than that. Okay, I have to do this exercise very painstakingly, but we do this. So now it's a part of our work. So every decision is captured, every decision is, I'll probably have a slide later on, but we know why we did what we did. If a company came into our radar, if we ignored it, what was the reason? Okay, why does it help by the way? I can go back and check if I rejected all these companies for a particular reason, and those companies were eventually wrong mistakes. So if my mistake percentage is very high because of one particular reason, I know I am goofing up there. It happened with me, I think 3 years back, 2 years or 3 years back. I got an epiphany that I'm very, very conservative on valuation front. Very conservative. When I changed that model, things work fine. So how do you learn? How do you evolve? If you don't have good basis to ask those questions, you're going to evolve with the pace with the brain can do a little bit of information gathering. Does that make sense what I'm trying to say? Okay. So a lot of things happen. We do a lot of different things. Let's move forward. Okay, so let's now understand the two. So why was this whole context important? Is because unless and until I give you a context of thinking in terms of evidence paradigm, why fooling by backtest is such a thing?
Could you try again?
Happens every time, right? Okay, why it happens? Why eventually backtesting is so important, or backtesting engine is so important in the context of thing, is something which you won't appreciate if you don't understand where does it fit in. Okay, so where does it fit in? In this context, this is just one line. It's fitting here. Okay, and this is, nowadays we don't do Google, we do ChatGPT, right? So I asked ChatGPT, what is backtesting? And I know what it says. Backtesting is a method used in finance investment. It's a trading or investment strategy. And that is unfortunate that is how backtesting is thought about. That's a strategy testing mechanism. But it is not a strategy testing mechanism. It is any kind of hypothesis testing mechanism. You don't just check portfolio strategies. You check every question you have in your mind going backtest. What exactly is backtest? What is the meaning of this term? Go back and test. And it's not rocket science, right? Back, test. What can you test? You can test everything you can probably frame into a decent question which is worthy of a test. Right? So if I want to test that, okay, let's say whether interest rates have anything to do with banking performance. Okay, or whether this particular company has a pricing power, or is this particular parameter can be used as a substitute for knowing whether there is a pricing power in this company or not. All those things are also questions, and all those things you can answer if you go back, you test, and you see in what scenarios this answer is very fine, and if it works beautifully, you have something figured out. You figure out something. It's just not a strategy testing thing. Okay, even though in my complete presentation going forward, I will be talking about strategy, because that is how it is used. But I want you to take away this, that backtesting is not only for strategies. It is for any question you can come up with in terms of an investment hypothesis. So, where does, in my experience, backtesting fit? As I've already told you, just this part. But the first thing which I see people doing very wrong is that backtesting is not meant to develop strategies. Can I go slightly technical? You've done that in and out sampling kind of thing, sampling biases you must have studied. I think it's there in CFA material also, level 2 or level 3, something like that. Okay, so sampling, in sampling, out sampling errors and all that kind of stuff you must have studied. What you do is you go back, you create something from the data, you do a forward running of that particular strategy and you say, okay, whether this works or not works. Okay? First of all, it is very stupid thing to do. It's actually not a stupid thing to do, but in India, there isn't just enough data for you to do that. That is problem number one. And secondly, you need to be very, very cautious. So this second part I'm talking about, data exploration. It is technically not wrong because you can get a lot of things from the data itself, something which probably you're not thinking, but because of the computing power, computer can give you that. It's not a bad thing. The problem is that it will give you way more than what is really beneficial or important. So the work which goes into figuring out the wheat from the chaff or the noise from the signal or whatever word you want to use, that becomes more crucial rather than if you try to approach it differently. So what is a good way to approach? Start by first principles. What makes sense to anybody? You ask a veteran or somebody younger, if everybody agrees with something, that's a good place to start. Rather than trying to get the data from them. We'll again see all these examples, right? So, yeah, so the aim is to test. Again, going back to back test. It's not back develop. I don't use back test to develop anything. I use back test to test things. Make sense? Alright. Okay, then there is this last point, which is back test is also not just testing. It's to also see and question why that particular statement is being said, what are the fringe cases, and maybe can I get something out of this which the other person who made the statement didn't think of. Right? So, when very common statement somebody makes is, remove cyclicals from your portfolio and your portfolio performance will become better. Can I go back and do my work? I can prove that hypothesis, sure. But can I also figure out what can I do which will probably remove the issue why cyclical is being removed in the first place. So it is not just testing of the idea, it's also to see that can I get more from that particular hypothesis in the first place. Does that make sense what I'm trying to say? Okay. Alright, so now let's get into certain examples. Let's start doing things a bit. Okay, so let's go into the anatomy of a backtest. Let's take two strategies. Okay, the easiest way to do is take one momentum strategy, one fundamental strategy. And I'll keep it very easy. So don't take the strategies and start deploying money. You won't be able to anyways. They're so badly formed. But don't even try that. Very easy strategy, but let's go and understand what probably can go into creation of such a thing. Alright? So why I have taken these two? For obvious reasons. Momentum, unfortunately, can only tell you about the mistakes you do with the price and volume data. It won't tell you the kind of errors you can do with fundamental data. And fundamental data obviously is a much more, it's a massive problem to be solved if you want to do any testing based on fundamental data. Right? The first is starting with the definition of what fundamental data really means. What exactly is fundamental data? Anybody? What is in fundamental data? The moment people say fundamental data, what do they mean? One is financials. Is that the only fundamental data?
Qualitative data.
Qualitative data. Okay. Let's call it qualitative data.
The defining factors.
Defining factors. It's not really data, right? I mean, so the point here is the moment you say I want to create a test based on fundamental data. Okay, factor is the second step of things. It is being developed based on the data itself. So that doesn't really capture there. Right, so there is no clear definition. Anything which is structured, non-structured, but talks about the company or the industry or anything becomes a fundamental data. Right? Related party transaction, is it a fundamental data? Of course it's a fundamental data. Right? Shareholding patterns, is it a fundamental data? Of course it's a fundamental data. Maybe not. Maybe the way you look at it might not fall into that. So the definition also is very clear. So let's take these two statements. Simple. Some momentum strategy says portfolio of companies in long-term absolute cross-sectional momentum tend to provide better risk. Heard of these kind of gibberish? I'm pretty sure you must have heard about this gibberish. Every time a momentum comes, तो दो वर्ड जरूर यूज करते हैं, क्रॉस सेक्शनल एब्सोल्यूट बिकॉज दे हैव टू शो, एंड सेकंड थिंग इज रिस्क रिवॉर्ड. बट दिस इज fundamental investing, again very common views. Investing in quality companies with clean financial, with scale opportunity is a great strategy. Alright, let's say you have to do these very two simple small hypothesis testing. So you start with a statement. You went to some, you came to my Stoic podcast, you heard some guest talking about something gibberish like this. You went and said, let's test this. What will happen? What will you do with momentum? How will you start? Think, how will you start? Let's take a 2 minutes break to think about it. Anybody has any ideas? Let's throw around. Collect the price data. अच्छा, अभी थोड़ा formulation में रहते हैं. Do the hard work later on. First, just plain English में, what would you even think about doing?
MACD crossover. MACD crossover.
You're going too technical. You're a new guy.
Top gainers would make it.
First of all, you have to define all these things. What does long-term means? What does absolute momentum means? In this, because the definition is not there. Your conceptual definition is there, but the mathematical definition is not there. For what might be an absolute momentum for you will be very different from you. Similarly for cross-section. Similarly for long-term. If I want to test this, should I ask an intraday guy 5 days? What does that mean? Right? It's too long term. Okay, so when you ask somebody, you also don't know what he's talking about. It's like when we used to go and meet management, I've stopped doing that. But a management guy says that, the operating profit margin of my business is this. After third time, I had to start asking, sir, what do you mean by operating profit margin? Because one CFO means gross margin also as operating profit margin. Somebody means EBITDA, somebody means EBIT, somebody means PAT. Somebody will mean cash PAT. So you'll have 5 different definitions of operating profit margin. So the moment you hear these terms, you need to start putting some context to it. And why is it important? Is because that is also a variable in itself, which needs to be tested, so to speak. Okay? So do all these definitions. So you define momentum at the first phase. Okay, there are methods. I'll slightly go faster because we have to cover. Then you have to think about how frequently I have to test this thing. Right? Any kind of testing will require you to, what is the frequency of me doing this? Some momentum guy will say I do daily testing of momentum number. Somebody will say it's a weekly momentum. Somebody monthly. Somebody says I'm a long-term momentum person. So monthly charts is the only thing that works for me. And so on and so forth. Right? So a lot of things are there. Then there's allocation logic. If you are going through the portfolio base. So there are ways to test everything, and it's not, I'm talking about testing as if we are testing a portfolio. But generally, there are many other things you can also do. It's not just portfolio testing. You can do other testing also, which eventually then has to go to portfolio. But here, bear with me that we're only talking about portfolio testing. Alright? Similarly, there's a concept of look back period. Somebody says 6 months is good enough look back for me. Somebody says 12 months. Somebody says 12 months minus 1. Or ignoring the most recent month. Why? Ask them. Okay. Then somebody talks about volatility. There's so many things you need to zero down to for you to even say, okay, what do I really mean by this? For somebody, this is not momentum. For somebody, this is only the momentum, which is the quality of the journey. By the time the stock reaches the momentum phase, is also equally important. Does that make sense? I'm just trying to give you a picture of how hypothesis testing starts. And it doesn't start with saying, chalo yaar, let's open a EV broker or Metastock or whatever tool you use to do anything. Alright? So that is where you start. Okay, so let's say you're doing, you end up and eventually you have to reach a final stage of saying, okay, I'm going to do this part. I'm going to create a portfolio with 20 stocks, with Sharpe ratio as my substitute for momentum. And this is not a thing which you start with, this is a thing you reach to. Okay, and this is also a thing you constantly need to change, but not to change to fit the data. This is also what people do. यार एक ये वाला इंडिकेटर काम नहीं कर रहा है, इतने सारे दिए हैं indicators. I have the computing power. Let me find the indicator which works best in the backtest. Be honest, we do this, right? Not only that, ये 200 नहीं चल रहा है. Let me do an optimization to see whether 160, 170, whatever the system will tell me. And then you hear that, then that thing comes in the report that we backtested a portfolio with 30% CAGR. 30% CAGR is coming because the system tried its best and all it could do is 30%. Getting my point? Because you said optimize with all this and give you the best possible result. And he said 30 se upar nahi de sakta with all these parameters. And this is the problem you have with curve fitting, so to speak. Right? So this is hypothesis creation part. Similarly, fundamental. Let's talk about fundamental hypothesis creation. Just go back to the statement again. Can you take an attempt now? Since you understood what is it? Take an attempt. But we'll go into just starting with this hypothesis. Defining quality. Defining quality में इतना दिन निकल जाएंगे कि आपको पता ही नहीं चलेगा कि हुआ क्या. I started with a very small statement कि quality companies make money. But anyways, yeah, go ahead. Clean financials. Then scale of opportunity. Sounds like a very simple thing to say. Right. So, and then great returns. That also requires a bit of understanding. What is great returns? What does that mean? 1% alpha? 20% alpha? Okay. So all these are questions to ask, right? So, and then there is an art part and I come to all these things. And then there is a testing methodology itself. So how do you eventually go and test this particular thing which you're talking about? Okay, now I'm not really going into an exact hypothesis creation because generally your statements are not this easy sounding statements also. You need to, eventually the final strategies are much more complex and the hypothesis creation itself, what I'm trying to prove here to you is that the creation part itself is where so many mistakes, goof-ups, stupidities, errors, biases, जो सब हमने इतना कुछ पढ़ा है लाइफ में, can happen. Okay, so how do you define quality? How do you define quality? Anyone want to take a chance? How do you define quality? I don't even know what to say, but okay, fine. Define always. From starting, okay. Define upwards. How will you say upwards? Is this line also works? Or only it has to be this line? I'm trying to get what I'm trying to say here. Define upwards. 1% CAGR for 10 years is also upwards. Okay, alright. What else? Okay, so if the price is continuously going up, which is also the hypothesis behind low volatility stocks, right? That's the eventual understanding, economic understanding is that good companies have low volatility of stock prices and hence it tends to do better, is the underlying assumption. So you are right, I'm just making fun at your expense, but it's a decent thought. And okay, maybe price in itself, give market wisdom the doubt, and the market is not playing around with the stock price too much, maybe there's something about the company. Sure. What else? Promoter holdings. Okay? Yeah, keep on going. So, what does that mean? Promoter holding kya? So, no Infosys. Okay. Yeah, what else?
Clean management history.
Sorry?
Clean management history.
Clean management history. So, opening of Pandora box. इसको बोलते हैं opening of Pandora box. What does that mean? Clean management history. How do you test?
Management should not be involved in any fraud.
Management should so innocent until proven guilty. like the
Free cash flow.
till somebody doesn't write a report on you in US, you are fine. You're a great manager. Right? Anyways, yeah.
Free cash flow, good balance sheet.
Okay, so free cash flow, good balance sheet. Define free cash flow.
Consistent improving numbers.
Define free cash flow. I'm saying it because a great guy comes on TV and talks about free cash flow compounding, which doesn't match with any free cash flow computation I've ever done in my life. But so define free cash flow. It could, it seems, it's obviously possible that the definitions differ. What is free cash flow? So CFA में पढ़ाया था free cash flow to equity, free cash flow to firm. Then Buffett said, no, all this is gibberish. Owner's earnings.
Yes.
Why High honors earnings because smoothing of the capital expenditure. And some people say, we don't take advances in that number. We take only the capex number, sale, purchase, not advances. So many ways you can compute that number. I hope you're getting the point. And that is why the art, understanding and all those nuances matters. That is where I also feel a problem with how quant approach this problem. And again, no offense to a quant who does the other way around. I mean, I'm just saying in generic way. How usually a quantitative guy starts thinking. Which is where the art part also comes. But anyways, so you're understanding this point, right? There's a lot to define to do any kind of testing. So many people say, okay, return ratios is the way I define. Like Buffett said 1977. What are you doing here? Buffett said, managerial economics ka best source is what? ROE. Except certain cases, which he never mentions, and balance sheet without leverage, of course. That is why ROE will matter, otherwise ROC will have to come into picture and so on. Does that make sense to everybody? Any doubts so far? The moment start going slightly up, just let me know, okay? Some people say leverage as a parameter which contributes. Some people will say business and management characteristics. Okay. And if you go into I am a fundamental, I started my investing education started with Warren Buffett letters because it's the first thing which was given to me to study. And I've evolved from there. So the attempt is to know more and more and more and more about the industry. And that's how I'm no stranger to the narrative segment of it. If you think I'm a quant, you are highly mistaken. Highly mistaken. You couldn't be more wrong. Let me put it this way. Okay? So there's so many other things I can probably give you in terms of list that will probably go in defining the quality of the company. Let's define that. Okay, let's say we zeroed down. We said, okay, return on equity return ratios make sense. Which return ratio? ROE. Why? Buffett said that. ROE. Okay. Never ever question the guru, of course. Right? I'm serious. I'm not joking. So ROE. So we start with ROE. I'll ask you, okay, what ROE? What should be ROE for a quality company? 20%? 25%? 18%? Some report I read was saying 17%. I really want to know how he reached that 17% number. I pretty much know the answer. कौन से number से CAGR सबसे ज़्यादा आएगा? Right? So 17%. So that becomes. But anyways, so 20%, 25%. The point here is it doesn't matter. All these things, it has to make economic observational sense. You don't have to go too accurate. If an idea works with 20, it will work with 22. If 20 and 22 is causing all the issues in your idea, there's something wrong with your idea. It's not the problem of the maths, it's the problem of your thinking. Okay? So if you do 20, 25, some people go even one step further. How about delta to the risk-free rate? Fair idea. Let's take a 91 debt equal rate. It has varied from levels of 3 to levels of 11. So if I am a company and I am using this cash to generate money, in sometimes even if I have generated 10%, it's a very good number. In sometimes even 20% is not good enough. How do you do that? How do you define it? 2000s, early 2000s, even earlier in the late 1990s, interest rate was so high. A company making 12% would not have made any difference whatsoever in terms of the equity return, so to speak. Okay, so how do you define that? Somebody spoke about that. Then ROC, ROIC, and again repeating the point. All these things eventually are a role there, but you also have to know where to draw the line because then it's a Pandora box. Hypothesis ही नहीं बनेगी. Forget about testing of the hypothesis. You will not be able to zero down what to test at the first place. Which is also a difficult part, which is also a good part because it makes you ask questions as to what really should matter. You go back to first principles. Why am I doing this? At least in my current understanding, what should matter? And if these three parameters, changing of these three parameters makes so much of difference to my outcome, there is probably something wrong with the hypothesis I'm testing in the first place. Because conceptually, they are supposed to tell me similar things. Maybe for one company, one or two companies here and there, it might differ. But at a portfolio level, if I'm doing a strategy test, it shouldn't make that much of a difference. And if it is making, there's something wrong. Getting this point? Alright. So yeah, leverage, business management, pricing power. Again, so people try to do, how do you define pricing power? How do you define pricing power? One is you ask a smoker, how much was the ITC cigarette 10 years back and how much is today? You know the pricing power. One is intuition, you observe. One is your understanding of industry. Okay, but all those eventually will boil down to something, which is gross margins. That's how you usually define pricing power. Eventually, then you say, okay, gross margin, but kaise? So there is a part of how do you convert what is there in the data to something which can then be used into some testing framework you're using. Should I use standard deviation? Should I use volatility of gross margin as a substitute to pricing power? All these questions you have to ask, right? Whether that is a good, so whether consistency is better or maybe quantum is better. Let me ask you a question. If one company creates a ROE of 30% a year, 1 year, next year it is 70%, next year it is 50%, next year it is 110, 20%, and so on and so forth. Would you define it as a good company? Solid company, yeah. Forget about the volatility. Right, look at the numbers. Okay, sure. I mean, let's assume everything else is in place. Yeah, don't spoil the message. Yeah, but the point here is sometimes volatility might not be a good mathematical construct to use in a time series, and sometimes volatility might be a good way to see. All these questions eventually have. I mean, it's not straightforward. Is what I'm trying to tell you. It's not that okay, this worked in that hypothesis. Let me use the same thing here. Probably can't. You have to think, and thinking part comes with experience part, which is where all those art part comes into picture. Okay, pricing power, so many things, and use certain things which you can probably use. Let's look at defining scale of opportunity. How do you define scale of opportunity? Some people say page का scale of opportunity किसी को समझ नहीं आया आज तक.
Number of players in the industry.
So, industry understanding the way to know about the scale of opportunity, commonsensical. Okay, let's talk commonsensical first. If I ask you, how do you know about the scale of opportunity of a particular company? What would you?
Number of companies in the industry.
Meditation. So the problem with scale is that scale is a forward-looking thing, right? So if you go back to check that, you have to basically be comfortable with that idea, and not many people are comfortable with that idea. That past can give you a good picture about the future. Okay, so I agree to some extent, but not fully. So I'll come to that now. Does that make sense? So okay, some people say historically, constant growing sales means that the company has a industry, which is where it is growing. Quantitatively, some people define it as an upward moving slope, or even a stable slope of growth rate number. Okay, obviously that doesn't say anything about the future. It can be this and then this, but then you also work with probabilities. Okay, so lot of ways in which you can define your hypothesis. I'm not saying anything is right or wrong here, but there are many ways in which people define a lot of things. Okay, future growth is a very interesting. We did one study, as I gave the numbers in one of the previous sessions I gave. We did a thematic study for, it was more stock price study, not the fundamental study, but we did a thematic study. So we studied around 20-25 thematic reports. No, not reports, 20-25 themes, which, where brokers come and say, okay, this is going to happen in this industry 5 years down the line. ये होएगा तो ये होएगा, उसकी वजह से ये कंपनी अच्छी है तो ये लेगा. It's called a thematic report. Okay, so we did that. We found that, surprising, we found that zero got their price levels correct. Correct, close. Zero thematic reports did even reach anything close. I mean, what they kept the level for themselves. Not a single theme or thematic report was able to achieve what they aimed for. Okay, and the starting data was 60 or 70. I don't have the numbers ready with me, but 60 to 70% didn't even meet the benchmark. forget about ये हो जाएगा. So future prediction is difficult. Let's put it this way. So you can probably understand a lot about the industry and still be dramatically wrong with figuring out your growth rate assumptions. Then some people will say the other thing कि अगर इतना ही नहीं हो रहा तो फिर past को थोड़ा सा guide ले लो. Right? If something has given you 5% CAGR for last 5 years, why would that become 20% all of a sudden? Does that make sense? So there are ways to think about this problem, right? Alright, defining clean financials. Is it becoming too heavy? I'm getting a sense. Too heavy? Right? Sure? Okay. Clean financials. What does that even mean, clean financials?
Good disclosures. Adequate disclosures.
Adequate disclosures. Just look at that company, just a US report disclosures.
Date maybe. Date levels.
In fact, the more the disclosures, they're the same. The more you disclose, the more you have something to hide. Okay, I don't know. The same. You don't quote me on this.
Date levels.
Debt levels. So debt means no clean.
But maybe one small barrel like date.
Okay, fair enough. Maybe. So the point here is maybe. If you do some work historically, you can prove that okay, debt to equity is a good predictor of whether this company has a history. All these companies eventually did very, very poor in terms of the quality of the balance sheet or quality of earnings. Sure, why not? Yes, so the problem with doing all these kind of first of all data is very difficult to get. But having said that, the more complex structure, I agree. But having said that, by nature, some bigger companies cannot avoid but have a lot of complex structure in the first place. That doesn't make them poor financials.
Amount of taxes maybe what they
But fine. The point is, you can think of all these things. All these are hypotheses. Maybe you are right, I'm wrong. But I probably have to test this to figure out whether just the quantum of related party transactions does it have a good correlation with what I'm trying to prove to. I have a sense, of course, that is where the art, experience, observation, pattern which your brain can capture, which a machine cannot capture, will come into picture, of course.
And that will have too much of related party for this.
Sure, because of the holding company structure only they will have way too much related party transactions. Understood? Getting the point? Okay. So clean financial is again something which maybe I can talk sometime later, but so, I had a discussion with a friend of mine who is into forensics a lot, and we probably discussed a lot of cases together, and we attempted, and we follow it to an extent. The whole experiment was that can we really quantify financial shenanigans to a large extent? Okay, and I made an observational statement. Observation is that, if I forget the ratios are not important, but I said if you look at these 4 key numbers, there's a good chance that 60 to 70% of the cases where there's something wrong will pop. We went back to test it and the number was not very crazily away from that number. Majority of the time, those 4 ratios gives you a good 60-70% cleaning up at the first place. I also know somebody who has 120 checkpoints to figure out whether there is a shenanigan in the company or not. Okay, now maybe addition up to 7 or 8 points can give you 90% accuracy. I don't know. We are doing that work as of now. As we speak, we are doing this work. Okay, so this involves creating a lot of stuff also for you to be able to test that. Okay, what about fringe cases? As they say, statistics, right? There will be fringe cases. Even if you find something with 90% accuracy, 10% will be there. And what if one Adani kind of thing happens in the middle? So you have to be ready, which is where your risk management comes into picture. If you rely way too much on data, that is what the problem I see with a lot of quantitative models also. They stop thinking in terms of higher the number, the more comfortable they become in taking more risks. Because their model says, its success factor is 93%. The model doesn't tell you your 7% kya kar rahe. So you need to refine your risk management in place. Alright, so as I told you, the art part. Right? All this cannot happen unless and until you have some context in mind. And the larger time you spend studying companies eventually will give you some good even though untested, but very good rules in your own head. And you can see, I told you refining process, right? How do you refine? If a list of companies comes and you ask a person who has no idea about the balance sheet quality or the industry or the company, for him it is no difference between ticker A and ticker B. But you can go and check, yeah, these 7 companies should not make sense in this particular list. So you go back and you say, okay, how do I refine my position? And that is how refining works. Now, if you don't have all those things, how will you refine? There's no way. Are you getting the point I'm trying to make? So it's not that is not important. It's very critical for you to be able to do this kind of work. Okay, but refining is not perfect. That is also important. You don't want to reach कि जब तक ये 7 companies में निकाल नहीं दूंगा, तब तक मैं refine करता रहूँगा, right? Refining is not about trying to find the most optimal parameter till the point you get what you want. It should at the core level have an economic reason behind why you're doing it. And after doing everything, if 2 companies still remain, you have to take them as fringe cases and you have to prepare for what happens then when these 2 companies happen. How do I deal with this problem? And that's a separate problem to solve. I hope you're getting this point. Refining is not comforting, which is a very big mistake in mind of people. So if I say, I don't want to name a company, maybe it is a multi-bagger and I have not invested yet. It's okay. Anyways, the point is a lot of companies that come into good quality parameters which you probably never heard of, and they probably shouldn't be there also. But they do come. And hence, okay, very important point. And that is also a very critical phase where you should understand the importance of interaction of different parameters with themselves. You can prove 5 parameters individually as great parameters, but when they combine together, they give you a very, very crappy result. And the other way around. If I just tell you, what CFO to post-tax EBITDA is a great way to find crappy cash flow numbers. Maybe at an individual level, it doesn't tell you anything. It might have a 20% prediction. And you just combine 1 or 2 ratios along with this, the prediction rate goes to 70-80%. Right? So combination of parameters works beautifully well where individual parameters will fail. And again, how will you do that? Either you become a quant, करते रहो जब तक मेरे को best optimal नहीं मिल जाता. Unfortunately, and I say this word unfortunately because we still have not become responsible enough, but unfortunately, quantum computing power is adding to the noise by giving this amazing thing to people who just want to say, let me find the best possible thing. And let me run the machine and machine will tell me. I hope you're able to put across this point. Any doubts so far? Any questions so far? Alright, so testing it all and so on and so forth. Simple enough. Right, what we did? All we did is starting with a statement and we just created the hypothesis. That's all we've done so far. Right? So, simple enough, what can go wrong? Let's say our hypothesis is now final. Quality company is ROE greater than 25%, less leverage, positive shareholder equity, and some 3-4 parameter or add. Okay, and some clean balance sheet is cash flow to CFO to post-tax EBITDA, cash tax to tax, low loans and advances number, and some consistency of receivables, whatever. You've created some parameters. Great. Your hypothesis is ready to test. What can go wrong? I've already discussed this, right? Before everything, we work in India. And India has a limitation of data. Okay, so don't expect a lot of stupidities to happen with the data. And not only the data problem, it's the availability of the data itself, which is a very, very significant problem to solve. In US, that's not a problem, right? You can create scrapers to extract data from the exchange itself, and you will get very high quality, schedule level data of financial statements easily in a structured database to work with. In India, try doing that. And even if you do it, you probably will be able to do it for the last few years. That's why we are over time. You go further behind, you'll have PDF scans. और वो स्कैन भी ऐसे होंगे कि विद आईज ओनली यू कांट रीड, forget about optical character recognition. With your own eyes, 6x6, you can't read some of the old reports which you go and find from BSc. So it's a genuine problem, it's a problem to solve. That is why the database and the database quality, don't even get me started on the kind of databases we have in our country. Okay, so it's a problem. और उस पे जाके upon will goes, let's do in sample out sample. I'll create a strategy from 2000 to 2010 का number. I will run that strategy from 2010 to 20. Works well. 20 to 30 I will make money. See, this craziness should stop. Has to do, I can't say, but it should stop. So yeah, sure. I mean, we can do a lot of things from global data. But then सब कुछ करना तो इंडिया में, right? Ultimately, we have to do everything in India. So there again, experience plays a lot of role. If you don't understand the dynamics of the markets itself, forget about dynamics. Even if you don't understand accounting standards, differentiation, you will create half of the ratios wrong. A very, very knowledgeable is wrong word, sorry. Very, very famous individual recently, I think some time back, did the same goof up with the ratio of CFO to post-tax EBITDA. They said CFO to EBITDA. Why? Because in every financial shenanigan book you will pick, it talks about CFO to EBITDA. Why? Because direct tax is not a component of cash flow from operations for the US accounting standard. Getting what I'm trying to say? Okay, so I mean, even if you don't do those small things only, you'll do a lot of goof ups. So carrying knowledge from one place to India also requires knowledge and understanding of a lot of things for you to be able to do that wisely enough. Don't copy paste. Take the idea, test the idea, but that idea formulation is where all the magic happens. And as you have seen, hypothesis formulation is probably, if you goof up there, बाकी सब करके क्या फायदा? अभी तो मैंने कुछ किया नहीं है, जो भी हम आगे करेंगे उसका कुछ भी फायदा नहीं है for hypothesis testing is only at a very poor level. And that is also what I told in the starting, Khurana's beliefs because of poor hypothesis formulation. Does that make sense? Okay. Is it too much negativity? Too much negativity? यार क्यों? फिर हम इस सेशन में बैठे क्यों? जब हो ही नहीं सकता तो क्या रहे? But anyways, let's see. Okay, simple enough. So we want to now test these strategies. Right? We have created the hypothesis. We have created a portfolio strategy which can now be backtested. Let's start. How do we start? First thing is to define universe. Define universe. Right? What can go wrong? Universe में क्या है? What can go wrong with universe? Universe definition has nothing to do with momentum fundamental. Everybody will get it wrong if you have to get it wrong. Okay, how do you define universe? Sometimes you go market cap based. Let's say top 500 companies. Okay, or everything above my 500 crore companies because they will be liquid enough. Some random thought will be there in your mind. I manage 80,000 crores. I can't go below a company which is already 3,000 crore market cap. Could be anything, right? So you define with some market cap filter. You will probably start with an index-based thing. Okay, let me work with Nifty Midcap 150 or Nifty 50. Okay, now the most common, later on I say this, but I call these kind of, ignoring this very simple problem, right? You know that constituents cannot be same, they are not same. And I still see majority of the people working on the company which are there in the index today and working on those companies to figure out whether your strategy is working or not. Why? यार कौन निकालेगा निफ्टी का historical data? You know how much work that is. It's a problem. See, I'm not denying it's not a problem. It is a problem. Unless you buy paid data, and not everybody, but all these people who can't buy paid data and are selling small cases will give you backtest results. Trust them, right? Because they're pretty sure they've gone and done all the work which is there. So the point here is, it's not easy. We just started, right? It's just index constituents. They vary. How much vary? I think that is 60% of constituents are different in 20 years of history we have. You go further back, pura index ही अलग होगा. Okay, of course, means the Okay? Number of companies greater than 500 crores. In 2000, we didn't even have 150 companies greater than 500 crores. Go Backtest data with that. And if you become larger, let's say to put up criteria of 3,000 crores, people do that. Okay, I'm not kidding. The hypothesis chart will let's filter out the companies with 3,000 crore market cap. The bigger organizations and institutions are doing backtests. They will start with larger market cap filters. Why? Because they're thinking today. See how many companies portfolio नहीं बनेगा. You want to do top 30 companies शायद ही होंगी, which were there at that point in time with 3,000 crore market cap. I'm sure maybe 30. But the number would be very small. Okay, so you need to be aware of all these things. Okay, coming back to, then we know this problem, right? We've heard about this problem, survivor's issue. If I'm not wrong, I'm pretty certain about what I'm saying. Around 43% companies which have ever traded don't exist today. 43%, it's not a small number if you think about the limited history we have. 43% of the companies that have ever traded are not there on equity markets today. They've gone down because of all these different reasons. Delisting हो गई, acquisition हो गया, demerger हो गया, ये हो गया, वो हो गया, bankruptcy हो गई, US में report आ गई, कुछ भी हो सकता है, anything. Right? There's so many things which happens. You go and backtest, and you start doing what? Yeah. How many companies are listed today, broadly? Trading actively on both indices? Rough idea. How much? 1700. 1700. See the 70%, 1700. It's not 1700. It's much more than that.
5,000.
Near about 4,000 odd companies you will find actively traded. 3,000, end of 3,000 to 4,000 something will be the, again, this will be an approximation. Okay, so around 4,000 odd companies. And I'm saying 43% of the companies that have ever traded are not there anymore. How many companies you think were there which are not there anymore? At least 2,000, at least 1,500. More than that actually, the number is much higher. Okay, so overall, approximately 7,000 plus companies have been there in the Indian indices from the early 2000s maybe. Again, all these are approximate numbers, don't take them exactly. But the point here is, can you run a strategy in 2003 without knowing or without having the financials of the company which was there in 2003? No, you can't. Which is the survivorship bias. Now, the most interesting thing which I've ever heard about, and this is a problem we discuss in great detail with the teams I work with. It's laughable, but the question eventually comes is, does it really matter? Even though it's a genuine question, but even if you have done no work, I don't think anybody can probably say that it wouldn't matter. For some strategy, it might not matter. It's a much more positive statement to make. Possibly, you can create a strategy in which those things stop mattering. Let's say a highly diversified portfolio. उसमें से दो गलत भी हो गए तो maybe it will not impact your portfolio too much. Possible. But if you say it doesn't matter at the first place, it's a big issue. So let's see whether it matters or not. Yeah. There are two of these problems, right? And then this also doesn't impact just portfolio testing. It impacts other testings also. Like in the last one, this is the problem 3 which I've written. So you're studying an industry. You want to study the margin pattern of a particular industry. And you want to see whether the company is profitable, good margins, etc., all those questions you have. And you're asking the company. So you're studying an industry. First, if you don't have all the companies which eventually die down because of poor performances, will give you an elevated number. Of course, survivors, higher margins. Iske margin nahi thi, wo to chara khatam ho gaya. Right? So that is one problem which I've already discussed. But another problem is categorization. In majority of the databases, ITC is categorized as diversified company, which it is. I'm not denying that. But try calculating the ROE, historical ROEs of tobacco industry, excluding ITC. Will you get a sensible number? Of course not. There is no way you can get a sensible number. You're removing the leader, and calculating industry aggregates by saying, okay, IT is a diversified map. And it's a problem. The problem compounded is that the database provider will obviously not give you historical categorizations. Okay, so the more you move forward, some companies which today are categorized well will stop categorizing well later on. For example, let's say you have a database provider who is giving you good data and Pyramid Enterprises is there. Okay, as a pharma company. Great. They went into NBFC. That guy, in his good judgment, thought, yeah, NBFC book is much larger than, let's say, the pharma business for whatever reason. Let's classify it back to NBFC. You get my point? So even if you have correct data today, doesn't mean that you're going to have that consistently going forward. And historical, I don't know of any database provider who gave industry categorizations historically. None. Zilch. Okay, so there's nobody. And it's a very difficult thing to do. For example, for IDC, at what point do you decide and move from a tobacco company to a diversified company? Kya hai wo magic number? After which you will say that now this is no longer a tobacco company, it's a diversified business.
Maybe a percentage of the revenue from the.
Good point. Percentage of revenue. Somebody will say revenue se kya farak padta hai? Look at capital employed. Somebody will say let's look at profitability. Yaar. All that matters is profits. So many views. So the point here is it's a problem, and this is going to make impacts. Now, how much impact is obviously it is going. You have to make the judgment call that whether that impact is worthy enough for you to go back and do all the hard work to change the data. Sometimes the answer is that the impact is too low. Like Kane said, right? Approximately correct versus precisely wrong. But I'm saying sometimes precisely correction is not something you need. All you need is approximations. And if you are able to figure out that this approximation will work equally well, then you don't need to do the work to correct data. But sometimes you need to. And how will you make the judgment call to the point you done the work? Get my point? Okay. So this is that error. Now, the only time using current constituents of anything makes sense is that when you are trying to study the constituents themselves. When you're trying to study the constituents themselves, for example, today's Nifty 50 components, how has their profitability risen over the last 15 years? That is the only time use current constituents in any kind of back working is a relevant thing to do. Otherwise, why bother? Okay, so maybe, and it's a possibility that majority of you will eventually go and say, "Yeah, practice make a chance." There is no point, and it's a fair thing to say. Or इतना ही करते जितना बेचने के लिए चाहिए, right? It's a possibility, but the whole point is, if the idea is that you really want to do this, to figure out a good strategy which you can rely money on and put a large amount of capital to, and you don't want to do this, you don't even correct for these basic errors, then why do that at all? Go chill. I'm also sorry. See, so take away that message that sometimes not doing things is also a good thing. Extra effort से कुछ नहीं होता. Okay. By the way, we were just at universe creation, huh? Just to give you the context of where we are. We are in the first one. This is only first one. Okay, no. What are the things we do? Alright, eventually there will be some data. ROE, PAT margin, some XYZ fundamental number will be there. Correct? Now, there's another problem. I think everybody knows this problem, but eventually it's a big problem to solve. If I run a strategy which is a monthly strategy, and I'm running it in, let's say it is going to run end of April, half of the company would have given you quarterly results, end of the year results. Half of the company would not given you quarterly results. Okay, now that is easy problem to solve. इसने दिया उसको ले लेंगे, इसने नहीं दिया उसको नहीं लेंगे. That's fine. But historically, how do you know which company gave what date? It's a possible problem. I mean, it's a problem which can be solved. I'm not saying it's not solvable. but it's a problem to consider. Majority of the database providers will not tell you the dates of the results. Result date is not a part of the capturing. So it's a problem to solve for, and if you get companies, think of it this way, if you don't have the dates and you're running it based on 31st March hai, I will just use 31st March, April ke end mein chal raha hai, so I'll take 31st March ka number. But we know for a fact that 31st March number does not come for the liable number, the annual report number doesn't come for, and we have 6 months time period to give the annual reports. Okay, so running on the strategy, going on, when you're running the strategy, you're using a data point which wasn't even available at the time when you're running your strategy. And we did this on a very, just for testing purpose. Okay, we don't do intraday at all, but we tested this on an intraday strategy. That only if you just change the price entry point, which we call look ahead bias. There's a technical jargon for this. Okay, but just average की जगह close price and close price की जगह average price kind of thing you take, the percentage difference can grow from 1000% CAGR. It happens, believe me. 1000% CAGR to 12% CAGR. Same strategy, nothing changed except for कैसे खरीदना, किस price में. So if you can make a strategy which will use close price, and your trading signal date and your entry date in your rules is the same date. Again, last time I said it, if you're doing this, you should not be even doing this. Right? But that happens. People do that. And crazy differences. Alright, so anyways. Now of course, higher the frequency, the more this problem will come. For example, you know that 6 months with IAIP statement. So I can run a yearly frequency strategy where the strategy only runs 1st October. Let's say. Okay, end of October. तो जो भी नंबर्स ईयरली वाले आ गए होंगे वो भी सब आ जाएंगे, तब तक दो स्टेटमेंट्स भी आ गई होंगी, क्वार्टरली रिजल्ट्स भी आ गए होंगे, एंड सो ऑन सो बहुत कुछ आ गया होगा. So it's a reliable number. So high frequency, the lower frequency पे you can still create, but then do you really act like that? That is also a question. So higher the frequency, more the errors. What's the solution? Is there a solution? There's a cheap solution, right? Which is what I just told you. The cheapest solution is you have the end date. So reporting of annual numbers happens at, it is reporting 31st March data. Let me add 150 days ka price gap or 180 days ka price gap on an average, and I will take that as my disclosure date. And instead of using reported date, I use disclosure date as my strategy running date. That's a cheaper way to solve this problem. Majority of the larger institutions solve this problem this way only. Why? Because the alternate then is to go and get all these data points. Is that problem clear? What the issue here is? Anybody who doesn't get the problem? Alright. Problem 2. The same data point, I mean quarterly sales of a particular company for a particular quarter, comes 3 times. Okay? So June quarter ka result, June quarter sales will be available in June quarter, will be available in September quarter as previous quarter number, and will be available in next year June quarter as a previous year number. So there are 3 filings for the same data point, so to speak. But the data can be different. Say, good reaction. This is precisely what people think, that eventually, ऐसा कैसे हो सकता है? What nonsense are you talking about? It doesn't happen, but there are 100 reasons why the data gets revised. It's not just. So somebody I asked, why do you think it will happen? He said, unaudited होते हैं, तो चोरी करी होगी. Audited हो जाता है next year तक, तो उन्हें ठीक कर दिया होगा. Which could also be one of the reasons, but that's not the only reason. Many things changes. Accounting policies keeps on evolving. We are in a country where we are trying to still map the IFRS and Indian GAAP together. So accounting policies can change. Sometimes natural revision can happen. Okay. Now you would say, but you know what? This problem will not be that big a problem. Or this problem might be a smaller companies. ये छोटी-मोटी company होता है, हममें होता है. Companies which have great ERP is a very good term to make narratives, right? You must have heard stories how companies become great by just doing ERP systems. But anyways, So, big companies, everybody uses the ERP system and they have good accounting software. They can probably have this. But you will be surprised to see how many companies revise their numbers. Okay? I've just kept some examples. This is Biocon, 2016 versus 17. Just see this number. This is rupees millions. Okay, so converted to crores. 16. By the way, I'm taking the number of shareholder equity, not some random line in the between which keeps on changing. Shareholder equity is your balancing number at the end of the day. कुछ भी change हो जाए वो तो नहीं change होना चाहिए, right? The number here is 3,288 crores in 2016. That number eventually becomes 5,996 crores. Next year, annual report. It's not a small change. It's 2,000 crores of addition to shareholder equity. And it's not a shenanigan. That's the first thing that comes to mind. It's not about just financial shenanigan. There are a lot of reasons why it happens. But it happens. And I mean, it's not a selective example also. And I'm trying even Biocon or bigger names can have this problem. Goldfish properties, there's a good accounting reason why this happened. But 2018 versus 19 number, if you see the equity here, 2240, this is 1210, double. If ROE is your parameter, just imagine, okay? ROE, after all that hypothesis testing, मेहनत करके we reached at ROE. Okay, it can have significant impact. Okay, so I'm showing you company where the numbers are significant and the companies are big. This is, I'm not sure if it works. Whatever the whole thing is, the loss after tax is 6,136, 12,000 for the same time period in two different reports. 12,000 crores. ऐसा भी नहीं कि decimal error है. JSW Steel. These are quarterly numbers which keep on changing. Bharat Electronics, just I mean, I basically just ran the database to see कि कहाँ पे है. But there are crazy amount of examples and large companies, all of them. Okay, but okay, what's the problem? Even in second, what's the problem? The problem is that you will not get what was the instance of that data at that point in time. Almost every database will keep the most latest revised number of that particular quarter and will give you that number. So you're running a strategy which is supposed to run on the quarterly number of 2016 at the end of that quarter, and assume timing is there and everything is there. Okay, but the number which you're using was the one which came in 2017 as a revised number. Getting this point? And ROE filters out. Impacts, right? It will make a dramatic difference. Another problem. Problems. Okay, but okay, the whole idea here is don't get dissuaded by all these problems, right? There are solutions you can work on. But okay, I'll discuss the philosophical part at the end. Okay, let me keep the core part. Then there is another problem, which is lot amount of companies historical data is available, but the company is not there. This is another problem to solve. Right? I'm running a strategy on fundamental points, and page industry comes in 2005. Right? Page industry ये 2004 से data मेरे पास. Company list हुई थी. I think in 2007 or 8, something like that. Somewhere 7, 8. I don't know. Database वाले ने data को दे दिया. He's doing good as per him. Going by doing all the effort, DRHP निकाला, you know, and he's giving you all the data. But then in your easy problem to solve. I'm just saying you have to be aware of this. You can very easily solve this problem by putting the trading filter when something traded or not traded. But you need to be aware of this problem. If you just work with fundamental data and you're running a screen, data is available, the company will come, you'll do all the ranking, weighting, etc., etc. But the company should not only be there. And when you see the backtest output, you don't see that, right? You don't see, okay, page industry was there, which gave multi-bagger returns, added huge chunk to my alpha, and then when I actually ran that strategy, none of those kind of multi-baggers ever came to my portfolio. Okay, then this is slightly more nuanced issue, which is there's sometimes even data ignorance, in the sense that you don't. Sometimes there are alternatives available for a particular data point, just not in the form you want it to be. Okay, and hence you ignore the data. I'll come to an example. Let's take a very simple example. Let's say you're running a strategy, okay, and that strategy has to run on 31st Jan. It's running on quarterly data, okay, and December quarter ka result for this particular company came on 10th Jan. One of those high efficient companies. There's some companies now which come in 3-4 days only, right? World record. One company I remember came in 1 day only, I think.
It used to come in 3 days.
Yeah. Yeah.
Now it's the last one.
No companies discussion today. I've come with a strict agenda of not discussing companies. Anyways, I'll ask you a very simple question. If let's say you have ROE as one of your parameters, how would your system, or how would you want your system to calculate that ROE number? Shoot. Shoot, it's a very simple problem to solve.
Backed by the equity capital.
ROE formula, backed by equity. Okay, equity or average?
Average.
That is also a question. Starting equity or ending equity or average equity? These are differences, okay? You might laugh at this, but a lot of people, when they talk about ROE, they will take starting equity because they will say that is the number which actually was the starting capital on which we have made this profit. So PAT divided by that number should be my ROE. Somebody will say, since equity gets added to the base on a daily basis, money keeps on coming in, an average might be a better reflection of ROE. Somebody might say closing, I don't know why they will say closing, but somebody might say closing also. That's another problem to solve, but let's assume for a matter that we'll take average. Or maybe let's just take opening or closing, whatever you want to take. Okay, so now tell me where it is going to come from. What PAT? PAT by equity. But what PAT? Trailing 12 months PAT. Trailing 12 months PAT. So, which are 4 quarters? Including the one which December return has just come, you will take the trailing 12 months. Fair enough? Fair enough? Trust me, majority of people will not do that. Why? Because, and I don't want to name it, but there are running ETFs in which people put money, where the underlying methodology takes the number which is available on 31st March of the previous year for the equity. They don't take the equity, and they don't take trailing 12 months. They take the P&L number because that was the last audited P&L number which you got. Quarterly to unaudited. Unaudited to the same year. Right? So, don't want to name it because then don't want to cause large amount of losses to anybody. But the point here is, people do that. But let's say you did TTM back. Great. What about denominator? What denominator will you take?
Equity for that period, if it's December, and then December for last year.
But where do you get December equity?
September.
You get September equity.
Yeah, last September the equity plus the profit.
Provisional. The provisional number that comes.
Yeah.
Unaudited shareholder equity. Are you sure you want to dilute your impeccable working with the unaudited number? Sure, you can. Okay, so somebody will say annual report number. And people do take annual report numbers. But you're right, the more closer number to take is September number. Is that all? September number, right? या उसके बाद भी है.
September number plus PAT and everything, just a closer number for December end. Let's say September equity plus PAT of.
Yeah. Excellent answer. Why not? Ultimately, what is PAT? Oh, sorry, what is shareholder equity? It is the profit you are making, which will eventually go in the reserves and surpluses at the carry forward number, right? And the profits is broken down into 4 parts. So you have the third part. Why ignore that third part? Just because it is not being given to you as a shareholder equity doesn't mean that you can't improve your shareholder equity number and get it a bit closer. Right? There's one problem with that. You're right. It's an excellent answer. One small problem. You're very close.
Capex.
Capex.
PPP. There is
Dividend.
Dividend, yeah.
So some dividend might also be a possibility that some dividend has gone between that equity number which came
Yeah.
and the 10th of January
Right.
or 31st of January, whatever the date is.
also some preferential or some issue of is that all.
No, no,
So
no,
we
no.
can include buybacks.
I'm just saying, let's assume simple companies. When you go into detail, there are so many nuances to consider. The biggest could be that the number only is not reliable. पिछला वाला. आज से थोड़े साल पहले तक companies were not even giving consolidated numbers at a provisional level. Forget about. It was optional. Standalone दे दो, consol देना तो दो, नहीं देना तो कोई बात नहीं. Shut down. Large companies also, not small companies. So these are data issues. But having said that, you can probably do dividend also. But then you need the exact date on which the dividend went. And you need the amount. Getting my point? You can do it. I'm saying these problems are solvable. But majority of the time, first they are difficult problems to solve. Second time, majority of the people will say, "छोड़ नहीं है, इससे क्या है?" Audited, annual report, audited numbers, and surprisingly, many of the strategies are running on ROE's numbers computed to 11 months back. Not even 11 months back, 15 months back also. Because the annual report for the next year has not yet come, the previous year was available at that point. Are you getting this problem? Two annual reports can have 15 month gap also, if you think about it. Okay, huge problem. Okay, now the question is, does it really matter? It's an important question because if it doesn't matter, why waste so much time and energy? You can see my energy is dipping down because of my levels are going down, right? Why? Why punishing myself? Does it matter? Well, it matters. Sometimes it matters. In investing, the best answer you can give to any question. It depends. If you don't know an answer, if you don't know any answer, say sir, it depends. At least if that is the level of conversation, the person will be impressed. He is not jumping to conclusion. What a stand-up guy. Right? So, it depends. It depends on what? Well, it depends on how you have formulated your particular hypothesis. How crucial is that parameter which is being affected by all these errors is to your whole this thing. If ROE is the only criteria on which you are defining your quality, and that number can change because of all these issues we have heard, of course it's going to matter. Of course it's going to matter. Right? Along with that, assume that you're testing a 10 company portfolio versus a 50 company portfolio. Right? One or two. In any portfolio, we know for a fact that few companies contribute to majority of the profits. Right? Not all are going to be great. That is why you do equal weight. Equal weighted, market weighted. But anyway, we'll come to that also. You agree with this, right? Not all portfolios made, there will be few contributors. What if that contributor came because your ROE was computed wrong and the company that didn't come was the main problem? It can work other ways also. That a company which are screwing up their returns might not have also come. But then you are doing it to put money for making it. You're not doing short strategy tests anyways, first of all. And the whole idea is to put money into an idea. Later on. Can you rely on that with all your truthfulness? And if you can't, then why are you doing this? Every time. Okay, that's the only message. Why am I doing this? If I can't solve for this issue, why am I doing this? You can say I'm doing this because it doesn't matter. But you have to reach that. You have to reach that statement. It is not assumed. It's not something you can go ahead with without any thought. Does that make sense? Should I take a pause in 1-2 minutes? Avoid all the negative air and then come back? Too much depression, right? It happened in the previous session I also gave. It was library of mistakes. Can you imagine how many mistakes I would have discussed? Okay. So yeah, so parameter dependency, churn ratio, how frequently are you doing the companies in and out? The more churn you do, the more chances of wrong companies coming in, coming out, the higher the chances of the issue. Right? Concentration, as I've already discussed, in companies. Outlier contributions. If outliers are contributing to 60% of your profit, total profit, then you're 1%. Right? Your all returns are about 1%. And then frequency of that, some discussed, right? The more frequency, the more issue it will create. Alright, so we have just done 2 parts, huh? Universe and evaluation points. If you are thinking the negativity is over, it's not. Stay. Then comes allocation reasons, allocation and frequencies and all that kind of stuff in your testing thing. We do allocation. Now, what is the problem with allocations? We have seen backtest results where the frequency of action is 1 year, frequency of testing is 1 year, and the portfolio is discretionary. Yeah, I hope you're getting the stupidity of this line only. The line itself is so stupid that it takes time to understand what the line is. It's a backtested strategy running on a yearly frequency, but in real life, it's a discretionary portfolio. Where on the basis of something, there is some discretion is being done. I don't even need to tell you how absurd that sounds, right? It is absurd, but it happens. Okay? The biggest problem I've seen in allocations is that the real life behavior is not being tested or modeled into. Now you might say that I'm not running a quantitative portfolio. Then does that mean that I cannot test a portfolio strategy? This is a good question to ask. It's a good question to ask. But can you make your portfolio strategy as close as possible to your behavior is something which you have to keep in mind if you want to rely on that kind of thing. I hope I'm getting. I don't have an answer to what will you do because that will depend on what the strategy is. Okay, but you can, and if you go deep enough, you go really put in the effort, you can model the actions to your actual live behavior as close as possible, even if you run a discretionary portfolio. We run a discretionary portfolio. Our biggest corpus running portfolio is a discretionary portfolio. We have a quant, we have a quality quant also, but the biggest one is discretionary. But all these things help me in making my decision more robust. For 2 reasons. First, I'm not saying that because my backtests have said 35%, I'm going to do 35%. That is the first thought, and that is why it's helpful, because I'm not looking for the magic pill. Right? I'm not the computer is not Morpheus. I'm not new. I'm just looking for good guidance, which will guide my behavior in a well way. Is that clear? Is that understood? What I'm seeking from? Alright. So, then there is allocation. Allocation, right? We talked about. So every good investor you talk about, you say stock pickings is another allocation matter. Not just line, right? Allocations matter more than stock picks. Okay? It does. Look at this. We did a portfolio. It's a market cap weighted strategy. I don't want to dwell into strategy because it's a running strategy version. Okay, but there is one strategy which we backtested, and 2006 was starting to test this particular strategy because the data was not available beyond that. We did the testing for this. The quantum becomes 8 times in 20 years. Okay, strategy, not a very great strategy. It's a 1 year thing, sir. What are you saying? If you don't generate 8x in 1 or 2 years, are we even doing equity investing? Okay, but anyways, this is the market cap weighted return. Okay, we did something called equal weighted. These are very common things. Okay, so there is no rocket science here. Equal weighted. So that 8 time became 16 times. and we say allocations matter. Of course, see, it matters. But can you derive any inference from this? Lot of products are being pitched, right? Equal weighted, better than market weighted. We have equal weighted ETFs. We have everything. And what's the whole idea? What's the underlying premise there?
We don't know.
Another pledge I took today is I'm not going to talk about biases. But anyways, you are right. But market cap weighted means you can manage that part. Because it's not that the market caps are jumping way too much, too high. In a very large frequency running, large years between each frequency, you might be right. But in a smaller frequency, the market caps are not jumping way too much.
Means we don't know the future. That's why we are able to.
So we can't predict winners, is what we are saying. It can come from the lower market cap segment, also higher market cap segment. That is one part. Another thing could be because higher market cap companies are getting more weights and it is giving you less returns, means smaller companies do better. But then why not reverse? We can do entire market cap weighted index. We did that now. Calculate market cap weighted and then reverse the allocations. If that is the hypothesis. We can do that also. But then we went one step further. We said, okay, so see, understand how the brain works. It is looking for something. It's saying, because I have heard allocation matters, I'm looking for the best way to allocate. That is how my brain is working. But you need to go further. You need to ask whether it really matters or not. The first question is whether it matters or not. So we went further. What we did is we randomized the allocations. Randomize the allocations. We didn't stop at randomization. We did Monte Carlo also to make sure all the instances are taken. But I'm just going in the easier part of things. Okay, because one instance can be profitable, another instance can't be profitable. There is a distribution, etc., etc. There is that issue, but that is not the point of the discussion. So if I give you this is the final return. Actually, this gray one is random weighted.
What about the reverse market cap?
I think it was somewhere in between these two.
You know how many stocks?
Not a lot, 25 I think. Doesn't it challenge your whole thing here? Maybe allocation doesn't matter that much. Again, I'm not saying don't take this out and go back to your fund manager and say कि allocation का इतना time waste करते हो. It doesn't matter. So the point here is that you have to question whether it really matters that much as you think it matters, or it doesn't matter. Even the range of my randomization might be deciding something here. Like if equated is, let's say 25 stocks, 4% is equated, and if my range is 3 to 5, maybe that in itself is doing the same work only. So that is why we didn't do that. We went from 1 to 9 to create that, because it will come more closer to randomization than 3 to 5. It matters. Of course, sorry, I said it doesn't matter. Of course it matters. What I'm trying to say is that if random is doing the same thing as equal weighted, see in this case, the market cap thing is not working. How do you know it doesn't work in any of the strategies? You can't look at one and come to conclusion. There has to be a reason of why this is happening. And that is what I'm saying. If you don't have an understanding of why, if you can't answer that in a narrative, with economic understanding, with markets understanding, then you're doing something wrong. Then it requires, then you're becoming I don't want to say quant because they're good quants, but then you're moving away from the realm of common sense thinking and just going by what the machine is trying to do. Which can open another set of Pandora box.
What is the range of weights?
1 to 9. I said 1 to 9%. Does that make sense? Congratulations, 3 down. 3 more to go. Yeah. Alright, so after we do all this, we see the returns and results. Right? What do we see? What is the ultimate output of a portfolio testing tool or a back testing tool? Any of you have ever done a portfolio testing practice? So what do you get? At the end, what do you get? IR is one number. What else you look at? एक पूरा टीयर शीट आता है किसी भी टूल में किसी भी उसमें ड्रॉ डाउन कितना था, मैक्स डीडी कितना था, सॉर्टिनो रेशियो कितना था, शार्प रेशियो कितना था, and all that kind of all PhD candidates with their names and their ratios eventually show up in the tier sheet. Okay, and on that basis we say here this strategy is better than this strategy. After all we have seen, would you want to change that stance? A simple tier sheet is giving you the characteristics of the portfolio curve. It is not telling you anything about what is happening underlying that portfolio curve. So much can happen, as we have seen in that portfolio movement, that if you are just looking at the tier sheet, and if that is the output of your portfolio testing, you're just adding one more error-prone study to your already done error-prone study. Now I think it's getting really disheartening, right? So what tier sheet पे भी डराया कैसे करें? So what you need to do is you need to, and every strategy is different, right? So every strategy you need to ask a question. But what is the most important thing for us to be watching in this particular thing? If I'm doing a concentrated portfolio, maybe the outliers of how many companies are contributing what to the portfolio might be a more relevant study to have as an output of the portfolio study than to study what the volatility of this particular equity curve was. Maybe studying individual trades and what was common in the trades which went wrong is a much better study to do than to worry about whether the Sortino ratios are less or more or whatever. I'm not saying those ratios don't matter. What I'm saying is they matter at the very end. And even majority of it is to sell something. Eventually what matters is that are you able to reliably act on it or not. And that is why we have to end up creating. So all our portfolios, different strategies have different tier sheets. Every tier sheet will have those characteristics which are relevant to that particular portfolio strategy or test. In a momentum portfolio, how does it matter कि मेरे companies का ROE? It's not even going in the selection criteria. Why would that information be important? Why would valuation be important? So in that tier sheet, I would not have all those studies. Tier sheet is the wrong word here, but let's call it a portfolio evaluation sheet. In a portfolio evaluation sheet, I don't want to see all those numbers. I want to see what matters most in this particular strategy. Because we keep on doing that a lot. Like these kind of breakdown between stocks, what were the more important profit contributors. So as you can see in this particular strategy, and this is a live data. So 21% profit came from one company of all the profits ever made. It's a concentrated portfolio, it's expected. I'm not saying it's wrong or right. But I wanted to see whether it's 80% or 20% or 60% or 20%. This also tells me that whether my actions, whether my performance is fluke or there's a systematic way in which I'm getting the performance. If top 5 में से one did all the difference to my portfolio, maybe I just got lucky. Is that somewhere you want to put your real life money into? Of course not. Of course not, right? So this is the kind of sheet these are all the close trades, one of the things but I've seen that gone into this kind, a lot of generation. Okay, so ignore that. It's not important. The point here is the message that you need to track what is important for that particular portfolio. And by the way, this is also a small part of that last funnel which I talked about in the structure, which is where we are doing post-mortem of decisions we have already done and taken. So if you're doing the spot, sometimes crazy things come out of this. Trust me, crazy good. Sometimes crazy useless things come out of it. Random. So that is where the difference between statistics and experience plus statistics come into picture. You know whether this number is a spurious correlation or a non-spurious correlation. Does that make sense to everybody? Okay, now, so 4 done, 2 more. How much time? Not much time. Okay, very fast. Bullet train speed, okay? Then there is improper modeling. And these are some things which you must be aware of. But I want to make you aware of how much they matter. Right? Transaction costs. They're often ignored, but in some of the high churn portfolios, you know the difference between one portfolio, let's say 60% return difference in a 6 year momentum portfolio. 60% return in the overall portfolio value, just with and without transaction cost. It can make crazy amount of differences. Okay, then it's an interesting paper by AQR Capital, which you should read if you can. We have to talk about the reverse side of it also. That in some people take transaction cost assumptions to be more aggressive than what real life transaction cost is for the institutions. Know both the sides. And know, at the end of the day, know your own transaction cost. That is more important. Right? Then a lot of things we build into our own backtests, right? Position building time. If you are managing large money, let's say you are an institution, you are managing large money, and you want to buy a stock, obviously it will depend on the kind of stock, whether you can buy in 1 day or 7 days or 10 days. Sometimes it takes time to build positions. Small cap portfolio, large amount of time, you need time to build a portfolio. So backtest mein you became very wise and you took the closing price of the day when the signal came, which is the first stupidity you did. But then you became, after this presentation, you thought closing price nahi dena, let's take next day. Right? That's a wise thing to do. Next day open. Okay, then somebody says, yeah, open queue. Let's become conservative. Let's take high. Next day, high price as my entry price. It's a good way to test the robustness of your buying strategy. But even then, you might be wrong. If you're an institution managing large chunk of money, you might need to have a way to distribute it, let's say in 10 days, to be able to do that testing. Getting this point? Right? Okay, so as I told, average transaction prices. What transaction price to take? So in our system, we take, if liquidity constraint meets and we are able to build position quickly, we'll take the high of the next day or a high average of 3 days. In the very small illiquid position, if we want to build, sometimes we avoid almost all the time. But if we want to backtest on them, we'll probably do 10 days, high price in my buying. So the point here is I want to be as conservative to tell me if that assumption itself is making so much of difference, then मेरी strategy is not doing anything. Transaction cost से ही अगर इतना फर्क पड़ जाए return में, then transaction cost becomes the core of that particular strategy, and I don't want to be in that strategy. You getting this point? Okay. Which is another problem with the impact cost, which majority of the small cases or institutions they don't think about. Momentum exaggerated by more subscribers buying the same strategy. Everybody sitting on Monday. Worse, automatic. Not even in control. Even if you want discretion, it's not even in control. Automatic buying will happen. Okay, so all your backtesting goes for a toss because the dynamics of the market itself is changing. And it becomes worse if your strategy is taking liquid stocks. Right, so good, smart people will solve for this. It's not that everybody is doing that. I'm not saying that all small case people are not, but some of my good friends who run small cases, they have solved for this issue. Right, so it doesn't mean that everything which you see here, so don't build that. Then go to the narratives. I tested a strategy which made 50% return from June 20 to 6 months, next 6 months, or next 1 year. A great strategy. That statement makes no sense whatsoever. Right? Now this is a very crude example of trying to put across a point. That how do you judge effectiveness is by comparing with something which otherwise could have been there. Let's call it that way. अगर ये नहीं किया होता तो क्या किया होता? Majority of the time, what you do is index. You compare every action with index. It could be anything, could be cash, could be anything. But the point here is you need to be able to select the right index. Okay, so in some of our strategies we use a cumulative index, whatever, not cumulative. We use a composite index based on the position of how many small caps are there and how many, because that particular strategy is market cap agnostic. So there are times when we are largely into large caps. There are times when I'm mostly into small caps. How do I make Nifty 50 as my base to compare that? It doesn't make any sense. Right? So what you do is, then you can do other things also. You don't have to every time make things more complicated. Sometimes you do easy solutions, like take a broader index, takes 500. A much better index, if you have if you're market cap agnostic, you might take a broader index to solve that issue. You don't necessarily have to complicate things by creating a composite index. But composite index gives me the best idea in terms of comparatives, especially in backtests. Again, understand, it's not about giving a picture to somebody else. I don't have to print that report and send somewhere. It's for my own understanding. And my own understanding is to improve my decision making. And if that information does not add to that, then there is no point in that information. It's just intellectual yarn. You getting this? Alright. Okay. Let's go back. We started with this topic after all the evidence lab thing. Even if everything is done well, even if everything is done well, and you spend all the effort, got the data, clean the data, did everything right, things change. There is no context, first of all, in the data. Ignoring context out of the equation. Sometimes context can be converted into data format itself. For example, I told you the interest rate scenario. Now that is a easily convertible, that market context has been easily converted into a data point. Sometimes the context, for example, macroeconomic, so could be global tension. There is no global tension index. Maybe somebody will create one. Like we have many qualitative things converted into indices. Maybe there should be a global tension index. And then something will happen. But there is no such thing. So a lot of context does not play a role into the whole thing. So when you are reading, making conclusions, you need to be aware of that at least. Okay, context specific. Regime changes happen, structure of the market changes, I have discussed in past earlier. First of all, the 500 biases which we study, and we have a plethora of understanding about, all of them are there. Easy to say backtest में कि 2008 में those are norms, every strategy would have made money. What's the big deal? The big deal is that after that also not many people actually made money. I'm pretty sure you would probably know some fund manager who is still waiting कि वो जो कोविड के बाद का रिकवरी आया था वो W बनेगा. Okay. Even if not, but they missed a huge chunk of the recovery because there was a prominent statement said by a good chunk of people कि V-shaped recoveries are rare. How do this shit? V-shape नहीं होता है, W बनता है, and all that kind of stuff. There are so many things. I read a counter argument. Somebody on Twitter wrote a good counter argument. So it said V-shaped recoveries are rare, but so are pandemics. It's a fair counter argument. Right? So the point here is, despite all this, if your eventual this thing is discretion, discretion can kill or make also. Sometimes you can be a good decision maker and curb with all the issues of the backtest by good behavior. And sometimes all the work can go for a toss if you're not able to act when you are supposed to act. And if you have been in markets long enough, you will know that is the most difficult thing to do. Ultimately, that's why I say Karma Bhumi, right? It's literally everything which is decided is being decided by that Karma Bhumi. If you don't do that, intellectual. Okay, so some more things you need to consider. You want to read fast so that I can skip. 5 more minutes. Okay, so to start things. So why do we do all these kind of, for example, random portfolio? Why did random portfolio make sense? Because you want to, how does a scientist know it works? How does it test the medicine? They don't test ki medicine nahi di and di. That was the old way of doing things. Now they give you a placebo and this. Maybe because you're getting ready because of your own brain rather than the medicine itself. Randomization is that way of bringing placebo. Maybe I'm thinking way too much about allocations, but that really matters. Placebo equivalent, iski jisko jo mein aa raha ho. And if it still works after all the things, then maybe it is placebo. And if my strategy is not doing better than placebo, right? Then one thing which I've often stressed upon is that use backtests not to find the holy grail, but to avoid the disasters. Okay, the last point is the most important point if you want to take. Okay, it is not about what to do. It's about knowing what not to do. Okay, and then what to do ke liye, you can borrow some wisdom from there, but don't rely on it with 100% confidence. Because eventually you will be proven wrong. No backtest is fully transferable to future, no matter how much you do. Okay, and that is why we do this anti-rules thing, which I told you. Reverse. ROE is a good predictor of performance. Okay, sure. Let's test with high ROE, but then also test for the lowest decile ROE companies also and see whether it works or not. And if it is not too much of a difference, then you're doing intellectual. You're just adding way too much where it doesn't matter. So now let's discuss the topic of the presentation. Okay, so why do I say fooled by backtests, right? Now after knowing all this, why don't I trust, whenever I see a backtest, my default position is I don't trust it. I absolutely don't trust it. For it's too much information, but for very few, it's simple. It's not easy. There's way too much that can go there. Secondly, you don't know what has been done. It's not about the errors only. It's about you don't know whether it has been optimized and given to you. You don't know what variables have gone into testing. You don't know whether variables are optimized themselves or given to you or not. There's so many things you can do to improve a backtest. And then sell that thing on Telegram for 500 rupees. Right? Sometimes you can take precautions by just asking common sense questions. Like a fund who says that we don't invest anything in technology, to then give you a backtest result of 7 years for a market which has been there for 100 years. Okay? You simply say, I don't trust it. I mean, I'm not saying that wrong or right, but I wouldn't trust it. Right? And the second thing I don't trust it is because so many people cannot be doing it right for very simple reason, because there's so many things you need to know for you to be able to do this. And a skill set gathering takes time. Takes time, takes energy, takes effort. So there's so many skill sets. And then there are no tools. If there was a tool somebody had made, we have made by the way. Okay, but without sharing. But if there is a tool that allows you to do all these kind of things, we're currently building also one, that's a separate discussion. If that kind of thing would have existed, I would still say, okay, maybe, even if they have not taken the caution, at least the tool have. But there is no such tool that is available. Okay, so I absolutely think there's no time, right?
Your plane is
Yeah, I have flight today. So takeaways, last slide, right? It's not for marketing. Backtests are not for marketing. But if you can't do anything else, then at least use it for marketing, because it works. So ultimately, what's the final thing which eventually most of the people have figured out? ये सब क्या करना है? Take narratives की dish, backtest का तड़का, data का जोक लगा के आगे story डाल देने का, which looks good, which sounds scientific, but eventually not much to do. Okay, and then be humble. Despite all the work you have done, the strategies are going. I remind of this famous line, right? Practice देखिए कभी-कभी अपने को लगता है अपनी भगवान है. And I've done so many great strategies. And if you do optimization, you can literally have great strategies. But then eventually you will be proven wrong. Okay, and probably the last point is most important. Take it serious. Eventually, if you really want to use it for money management, or managing your own money or somebody else's money, it's more cautious on the second side. Right? Then take it seriously, or else don't do it. Fair enough? Alright, thank you.
Thank you, Puneet. I'll not take much of your time today. Lies is less than damn lies is less than statistics. This is what I was taught in my CFA curriculum 10 years or 12 years back. I would now request Karan Sharma to present a small token of appreciation to the speaker.
I always want a stats book. Thank you so much.
Please join us over high tea. Thank you.
Thank you. Any questions?